Good afternoon. Good to see everyone again. Back from 6 months ago, and really excited to be here today. And I was thinking before this started that oftentimes you make predictions at the beginning of a year or the end of the prior year, and it doesn't matter whether you're right or wrong because no one really remembers what you said. I think this is sort of a point of introspection for us as panelists, where we get to be challenged by you and by each other as to whether what things we said back in January actually came true, and how right were we, how wrong were we, or somewhere in the middle. So excited to be here today. We're going to have a really jam-packed session with a lot of topics that were really front and center for all of you back in January and still are today. But in addition, we're not going to ignore the sort of the elephant in the room, which is the stablecoin and digital asset proliferation. And so we'll cover that in a different section and hopefully give some guidance as to where we think that will land for the rest of the year. But before we get started, I want to introduce the panelists who I'm excited to be with today. We have three other executives from Cross River, going in screen order. Hillel Alvasone, who leads our strategy group, Noah Cooper, who's our CIO, and then Ben Lelnicki, who's our CCO, really experts in their own domains, and as you'll see today, have a lot to add to the discussion. So without further ado, two housekeeping things. Number one, thank you to those who submitted questions in advance. We will cover as many of them as we can throughout they're actually interspersed in our questions. But in addition, you should feel comfortable and definitely feel free to post questions in the chat on Zoom. I can't promise we'll get to all of them, but to the extent that I see them coming in at the right time, I will try to stop and get to some of them throughout the program. So thank you for joining today. And again, looking forward to a very spirited discussion. It'll be very free-flowing and open forum, so you might hear some jokes in the middle. It'll be very much less formal than your typical webinar. In fact, just to throw out a fun fact, we're actually all in the office today, but we're sitting in 4 different locations, partly to make you feel comfortable, partly because technically it's much easier to do it this way. And so we're actually not in the same room, so you might hear us talking over each other at times as well, but we'll try to keep it pretty organized. Anyway, let's jump right in. Okay, so I think the first thing we want to discuss or look back on perhaps is the state of the economy and certainly the state of regulation in the United States. Back in January, we talked a lot about what the new administration would mean for banking, for fintech, for stablecoins as an example, what would happen in the first 90 or 100 days, what they would focus on and not focus on. And I think it probably is a good idea to start with Ben, who actually spends most of his time dealing with either the regulation itself or the impact of the regulation. And so Ben, maybe I'll throw the first question out to you. We thought in the beginning of the year that there'd be a rollback on regulation, a temporary freeze or pause on new regulation, and perhaps an easing of oversight on some of the industries that were most challenged, perhaps the prior 4 years. So if you could just comment first on, did we see that burden lighten? How did it actually play out? And how do you expect it to show itself through the rest of the year?
It's a great question. I appreciate starting on this, Adam. I think, I would just start with saying I think it's happening. I don't think it's happened. I think it's in process. We're seeing a lot of action in terms of both on the regulatory and legislative front. So, and that's been top down. So I think whatever one thinks about politics, I think this administration has been crystal clear about what they want and what they're executing on it with their plan. And that starts with promises around, doing away with an approach that was regulation by enforcement and really looking at regulated institutions in the fintech industry and crypto as well, and starting to say, like, we're going to evaluate the activity and the risks associated with it rather than bucketing specific counterparties or markets into different areas. But we're seeing it. We're seeing it there's been action through rollback or relaxation, as I like to say, of certain regulatory requirements. We're seeing it on the judicial and legislative front. And I actually I'm optimistic. And when I say this, it is sort of reflections, like you said, but I think there's still a lot more to come. But it's tremendous momentum so far, at least as we sit here towards the end of July.
Yeah, good, great points. Maybe one more follow-up question on that. Obviously, there's been some what we'll call geopolitical distractions, maybe from some of the things we talked about. Tariffs maybe one, other things globally happening. How have those distracted from maybe some of the things we expected? And obviously we have the stock markets at record heights. We have, things happening globally. How has that maybe shifted some of the focus in the new administration?
Well, I think it's a great question. As a related point to tariffs, I think what we're seeing in sanctions, there's actually an increased focus across banking regulators and at the Treasury Department on sanctions. And I think that's just a byproduct of the tariffs. So from a regulatory perspective, as I work with business partners, I think it's something that's top of mind for us. That's just the first thing that comes to mind when you're moving money, which is a lot of what we do here at Cross River. When you really break it down, and you move money across border, or you have parties that have more of a global presence, I think sanctions are top of mind, at least for me in my role and for my team.
Yeah, absolutely. Maybe moving to Hilla for a minute. Hilla, from your perspective, thinking about the strategy piece of this, what was the most meaningful regulatory update, perhaps, that happened with the new administration, and how did it impact the market? And as an add-on, one of the things in the past has been the difficulty to get guidance on how to achieve what I'll call gold standard compliance. Has there been any guidance given, and how have fintechs adapted to that?
So as far as regulatory rules or regulations or proposals that have been, either proposed or rescinded over the past 6 months or so, I think the biggest one that may have taken the community off guard is probably the Rule 1033, which is the open banking rule, which basically would have required all financial institutions to share consumer financial information or businesses information to whoever really wanted to access it if the consumer wants that to happen, right, or the user wants it to happen. That's, I think, we all expected to just continue and sort of solidify and make it a regular practice that really the entire fintech infrastructure sort of sits upon, right? The ability to have open banking and share information is really what powers a lot of all the different apps and functionality that a lot of the fintech companies provide and services they provide. So that one was a little took everyone taken aback a little bit, but the reaction to that, which interestingly over we saw the last week or so, was really JP Morgan's position now to say that they're going to charge anytime anyone wants to, hit their APIs to actually access consumer information, which is going to be really drive a wrench into the entire, as I said, really the entire business as a whole. We'll see how the market reacts to that. Companies like Plaid, Finicity, Yodlee, et cetera, have really relied upon the ability to access that information, and they regularly ping core systems of these banks to be able to access the information. And then the next level down from that really is the fact that any app or functionality or business really in fintech needs the ability to access that information to provide best services to their consumers. But it may seem now that it's going to be a little harder to access that information, or it's going to cost more. So there may be second or third derivatives, et cetera, of this market reaction or implication. It's to be determined what actually happens, but it really is a bit of a fork in the road in the future of fintech right now.
Yeah, it's a good point. I think Jamie Dimon's assertion of charging fees, I think, threw the whole market off. So certainly that's something to watch and keep our eye on. But we do expect, I would say, strong collaboration and guidance to come on all fronts from regulators going forward. Maybe to Noah for a second, fiscal, trade, monetary policy, all things that are really front and center today for all of us. But I think obviously inflation as well. In your seat, you see a lot of the impact that it has on consumers, small businesses, the overall economy. Maybe from your lens, how do you characterize both the state of the economy, the consumer, and how that impacts deal activity today?
Interesting enough, if you fell asleep on New Year's Eve and woke up today, you wouldn't think anything of consequence actually occurred in between. So just looking at some metrics, high yield credit spreads are roughly flat, 10 years down 20 bips. Fed funds rate is unchanged. We have a new reconciliation bill in place and new issues running at a healthy clip. Obviously, we all know that quite a bit happened in between, with the majority of the focus being really on trade and fiscal policy. So just first on trade, obviously, announcement of tariffs was a pretty material shock to the market. Saying that spreads widened out by the most really since COVID, gapping out, in the tune of 200 basis points. I think what we saw immediately after that, it's debatable whether Trump truly cares about the stock market, but we do know he deeply cares about the bond and debt market. So when liquidity started to dry up in the markets, when borrowing costs rise, we saw him come in and start to make some deals. And I think the 90-day tariff truce with China was probably that really seminal moment where the markets did snap back. Since then, I think we're definitely seeing issuance getting back to where we were at this point in 24. We're still lagging by a bit because of that disruption in April. But if we look forward, I do think the market is pricing in trade deals continuing to happen. They're sort of diminishing marginal returns as each deal gets announced. I think that the EU deal was a bit of a yawn fest, and obviously we're still waiting on the China front.
Right.
Maybe the other notable story was on the fiscal front. Obviously, not without drama, but the one beautiful bill passed on July 4th. I think I view this generally as consumer friendly. It extended the 2017 tax cuts, increased SALT deductions. It added things like the interest rate deductions for autos, and obviously removed taxes on things like tips. The one thing we are obviously mindful of is that the national deficit. We saw the 30-year, for example, go north of 5% leading up to the negotiation of the bill. And for the first time in really a long time, it does seem like investors are worried about the U.S.'s long-term ability to service its debt. So when you take into account the rising spending, the debt service, right now there's projected that the deficit could rise to 7% of GDP, which is obviously a far cry from where Scott Bessent is targeting around 3%. So obviously, if that doesn't change, borrowing costs will continue to be set front and center for all of us. The one other side of the coin, which maybe it just presents a little bit more of a glass half full approach, is the other lever that we can pull is that revenue and GDP growth can accelerate. And if we think about the pro-business environment, if we think about some of the efficiencies created by things like AI, I think it does give us some optimism that 7% of GDP deficit, hopefully will come down.
Hey, I like that optimism. That's great. Okay, maybe sticking with this topic and the overall market, I think one thing we know Trump does care about is interest rates, right? That there's no secret that he and Powell are not on the same page there. And maybe let's talk about rates for a second before we get to your predictions from January. How have the rates or the lack of lowering of rates, inflation, and consumer financial health shaped deal activity so far in the first half?
I think, maybe despite the federal funds rate staying constant at that 425 to 450 range, the movements in the shape of the curve are definitely healthy and supportive of markets. The 10-year is 20 bips lower, the 5-year is 40 bips lower. The 2s10s curve is about 15 bips steeper. Where CPI is down from 3.3 to 2.9%. And then the consumer side, the personal savings rate is up from 4.2 to 4.5%. So there are all of these things that are, like, I would say, considered modest tailwinds to the market. I do think absent the Liberation Day, pause we had in markets, we actually would be surpassing last year's issuance volumes. Albeit we are, I think in 144 ABS land, we're at like 110 billion versus 120 billion at this point last year. But I think we do anticipate some catching up in the latter half of the year.
Okay, so on that note, I did this to Ben already. I'll do it to you also. Back in January, I'll read it from the sheet. You predicted a breakout year for private credit, increased IPO activity, an increase in M&A activity due to attractive multiples, and a more friendly antitrust environment. How would you say these forecasts have held up so far?
Say X, the Liberation Day stuff is quasi right. Just putting some stats to it. Obviously, it was a pretty low bar in 2024. So in the first half, we've seen 100 companies, excluding SPACs, IPO. Over the same period in 2024, that was 63. So, up nearly 50%. As it relates to fintech IPO activity, I'm pretty sure in 2024, the first half we had 0. We did see 3 notable IPOs in the fintech space in early 2025. We had Chime, Circle, and eToro that collectively raised $3 billion. All those companies, obviously, in the secondary markets, are doing quite well. There's also a fairly robust pipeline. I think Klarna was one who paused during the whole tariff situation. Also, we've seen Wealthfront and Gemini privately file. So I think there is the opportunity for IPOs to continue to grow versus last year. Private credit, that theme continues to be a core theme that we see accelerating. By some measures, that market is now $6 trillion. That's growing at about 10% compounding annually. And I do think it's a very persistent feature for the space that we operate in. It does allow for more long-term business planning from a platform's perspective. And it does allow these private credit firms to allocate large amounts of capital. And overall, I think it just really helps establish this nice equilibrium in the market that, sometimes before we had this very, deal by appointment type market that when things were good, deals got done, and then things were bad, the markets were really dry up. And I think this private credit boom is really buoying, some of the markets when they're disrupted.
Great. I'll give you one more prediction you made early on in 2025. You said that a shift towards capital partnerships and JVs versus one-off deals. Has that materialized so far?
And I think for sure, and I think that's an extension of the private credit theme. We are seeing these like more bilateral partnership style agreements occur between investors and platforms. And just naming a few off the top of my head, we saw this Edge Focus, SoFi and Fortress partnership. Blue Owl, now Upstart, announced a large partnership. And then on the insurance company and asset manager side, we saw a fairly large partnership announced between Sixth Street and Northwestern Mutual. So I do think these JV style partnerships have proliferated in early 25.
Yeah. Okay. So I'm going to combine the last question from this section with a question we got from the audience, and the question is about capital commitments. That in a rate hiking cycle, perhaps, as you mentioned before, the void for funding comes from private credit. And I guess the question is, are banks starting to reemerge? Is the first part of the question. But also, we had someone submit a question that says, so A, have banks reemerged to supplement or maybe help out the private credit funding? And in addition to that, where would you see that remain the biggest funding challenges and opportunities in 2025?
Yeah, so maybe answering the first question, I think anecdotally, banks have definitely been larger participants in the market versus the previous year or two. I think they are really important partners in this private credit space. So everyone says like, oh, the banks are being displaced. I don't fully agree with that statement. At the same time, some of the data is a bit more mixed in terms of bank reparticipation markets. If you look at things like senior loan officer surveys, the banks are still neutral to tightening across different asset classes. And then if you look at some of the earnings, like JP Morgan, B of A, Wells, Citi, JP Morgan and B of A, their loan books grew by single-digit percentages, but you did see folks like Wells and Citi contract. And then maybe answering the second question, well, it's maybe an obvious answer. I do think that the time we're in now is even more paramount for the advice or what's the challenges for these platforms to really have equity that they can fund, whether it's their warehouses or they can retain residuals when they issue the ABS deals. And the reason being, obviously, borrowing costs are relatively low, again, in terms of like where spreads are. So there's high advances to be had, spreads are tight, and platforms can really earn outsized equity returns so long as they have the equity to support their businesses. At the same time, selling equity and residual in the market, there's still quite a bit of a bid ask in terms of assumptions, and the discount rates are high. And so not having that equity, in some sense, can be self-proliferating, and that you're having to sell things at lower prices or not being able to retain a lot of the earnings that you otherwise would have, and you end up in this downward spiral versus like having that equity, you can earn outsized returns if your assumptions are correct, and that obviously will help bolster your equity base.
Yeah, great content. Thanks, Noah. I think now we're going to shift to perhaps the most provocative section of the webinar, and that's on stablecoins and digital assets. For this piece, I'm going to turn it over to Hillel to lead, who leads our strategy team. And certainly, I think he and Ben back in January and also today will have the most to add. I think they're domain experts on these topics. And Hillel, why don't you kick it off?
Yeah, so we talked about stablecoin and AI, I think, as the two most provocative or influential areas in 2025. I think it's confident to say that that is correct. I'm not going to pat ourselves on the back for that. Everyone was saying it, but we were obviously listening to the market and what everyone else was talking about. And it's definitely come true. I think, we joke about this, but a few years ago, 5 years ago, every startup was a cryptocurrency company. Then they became an AI company. Now they became a stablecoin company. Now they're going to be a stablecoin AI company, whatever. So that's really where the market is headed. You can't talk to any company for that matter without them mentioning what their stablecoin strategy is. And if they don't have a stablecoin strategy, you start raising some questions about that company's chief strategy officer. So happy to say that Crossover obviously does have a stablecoin strategy. We'll talk about that soon. But just to give some facts on stablecoin adoption and where we are progressing over year, there's about, as of February 2025, stablecoin transaction volume reached $710 billion. Which was 36% increase year over year. There's a 50% year over year increase in stablecoin addresses, about 35 million stablecoin addresses. So it's clear that this is something that's here. This is not sort of the flavor of the month. It's going to continue. And we do feel strongly that for ourselves specifically, something that we must have, not a nice to have. We think it's a must have to entertain and work with fintech companies of all sizes. So we're very excited about where we are headed and where the industry is headed from a stablecoin perspective. Adam, just to ask you, if you could opine, are there any traditional banks that you've seen recently launch any stablecoin activity? Is there any specific ones that you feel are notable to share that could have impact on the industry as a whole?
Yeah, despite Jamie Dimon's maybe reticence when Bitcoin first came out and his denial of it ever having utility, I think that we're seeing that shift. I think Chase, as one example, has a stable coin that's pegged to the US dollar. Bank of America has one as well. And so I think when you think about the big banks and maybe the non-banks have a different view. The big bank view would be, a stable coin makes sense specifically when pegged to the US dollar, and that could be a form of removing friction from the financial system. On the other side, the non-banks believe that other types of coins that aren't necessarily pegged to a US dollar or something that's stable could have utility as well, perhaps for cross-border reasons or other reasons. So I think that there's a dichotomy in philosophy. That said, I think everyone, including big banks and small banks, has to participate. I think the folks that maybe are lost in the shuffle a little bit are the smaller banks, the community banks, who have yet to adopt, to your point before, Hill, a strategy, and they're still figuring out how they can participate. Luckily, CrossRiver has been ahead of that curve and been supporting digital asset players, stablecoin players for payments, money movement. Obviously, I think some know we have an internal network that we've built to allow folks in the digital asset space to move money amongst each other. Without friction, 24/7. We call it CR Now. So I think aside from CrossRiver's activity, I think you are seeing big banks participate in different ways, but I think that their focus is going to remain on the safest assets, such as stable coins that are pegged to the US dollar. And I think other folks that are non-banks perhaps will continue to proliferate other types of coins, other types of assets that maybe are perhaps slightly more volatile than banks are willing to do.
Yeah, 100%. We continue to see announcements in stablecoin every single day. I think today or yesterday there was an announcement with FIS and Circle talking about bringing stablecoin usage to the FIS or community banking world. We actually invested in a company called StableCore, which provides infrastructure services to the core processors and community banking world as a whole. So as I said, we continue to feel like this theme is going to sort of bull rush itself through financial services over the next many years. Ben, one of the things we didn't talk about though was stablecoin when related to treasury management and services. Are there any traditional banks that have actually launched stablecoin products that you feel are noteworthy since January or can talk about? or back office traditional banking services related to treasury management.
Yeah, I think Hillel, what's interesting, just as a side note, when we talk about stablecoins, what's interesting is AI has actually made it. Uh, this is this fascinating observation. I think that it's been a lot easier to follow a lot of the developments, digesting these bills, that were hundreds of pages long around stablecoin legislation. I think with AI, we used to have to go read 14 law firm memos. So I think it's ironic in a sense that technology is helping solve the technology. But in terms of what other banks are doing, I think it's stable coins is are front and center and it has to be part of your strategy. And the strategy is also your business strategy and your regulatory strategy. So I think, but it comes down to blockchain technology, distributed ledger technology, and I think banks are really exploring a lot of different ways to use the technology. For treasury management, we know there are a lot of institutions that are out there that are talking about ways to use a potential stablecoin, whether they are their own issued or it's issued by another entity, to move money internally, or to move money to allow customers to move money between one another. I think there's a lot of those projects, initiatives that are beginning to be developed that will enter the market shortly. For us, it's I think we're studying, and we're, like you said, we have a strategy. We're trying to make sure it's critical that you actually develop a stablecoin strategy from a regulatory perspective, where I'm sitting right now, that matches what your business model is and what your customers want. But there are some that are beginning to enter the market. There could be, when you talk about treasury management, it could be, again, anything from also whether you're holding the reserves as an institution now for a stablecoin issuer. It could be whether you're actually looking at a stablecoin as another way to manage your liquidity risk. I think the technology and the opportunities are limitless. We just have to find the right market fit, all of us together as market participants. And I think there's a lot that's going on out there, Hillel.
Yeah, agree.
It's
And so,
it's very exciting. It is. We could probably have a separate panel just on blockchain technology, the future, and and where it's going with respect to banks, especially.
okay, note to marketing instead of that panel. Okay, great, fantastic, great. All right, thank you, Ben. Maybe moving back to the infrastructure side of things, which Ben, I think you're most well versed to speak to. You mentioned before about a strategy, but one of the things that's kind of daunting to smaller banks and other players in this space is how to implement that strategy, and you can't do it on your own. You can't build everything yourself, and so much like every other industry, I remember back in the days of the old Lended conference, right? The conference started, it was like all platforms. So you walk down the aisles, it was like all platforms, and then naturally over time, what happens is you shift to being all vendors. And so it's not so dissimilar to this space as well, where it started out with everyone was issuing a coin or they were issuing a stable coin, or they were a cryptocurrency firm. And now most of the folks you see at conferences are vendors who are supporting those firms, whether they're helping with custody or helping with treasury management. And so in your view, Ben, in your seat, maybe what are the things that are out there that would help folks build that infrastructure and create processes around stablecoins and digital assets that would create a safe and sound environment within the regulatory allowances?
It's a really, really interesting discussion, because it comes down to, I think what you're talking about is the build versus buy sometimes, and the cold start problem. Whereas there are, I want to be very clear, maybe to start with remarks, is there are plenty of market participants who have spent over a decade in some cases developing market infrastructure, whether it's around custody or it's around compliance tools, or just trading tools, frankly, that are very well mature. So we should not discount the work that's been done by them. But I do think it's fascinating that there are a lot of, there is, I think, Hillel, you could probably relate to this more than me, sitting in your seat as strategy officer here at the bank, is there's always a vendor that has another solution that's out there. And it is exciting, Adam. I mean, the number of calls that come in inbound to show your potential tool that could help you manage risk, whether that's financial or non-financial risk, they're limitless. But when you want to talk about a stable coin or a cryptocurrency product and offering, your primitives are really what it comes down to. And so you have to think about foundationally how you're going to manage your private keys, what your custody solution is. Is it that's I would call it, it's foundational. How are you managing transaction? Are you conducting transaction monitoring? The same rules apply as a banking entity. The seat that I sit in as a CCO for a bank, it's whether the technology is ACH rails or, or we're sending wires or it's blockchain technology, you still have the same rules to apply. What I would like to see, and sitting in my seat, is really it's a market structure challenge. Is that we're going to get a little bit wonky, but I think the audience will find it interesting. Is that there are some parties who are what we call hosted. They are regulated entities. They're called VASPs, virtual asset service providers, and there are others who host their own wallet, who use their own wallet to conduct cryptocurrency transactions or just move value back and forth. And it poses challenges for an institution that has to comply with certain KYC obligations. I really am starting to see some great tools out there that are addressing some of these challenges that allow someone in my seat to actually mitigate the risk and allow the product and and business teams to actually scale. So I think that's something that I'm pretty positive about, that we're going to see solutions more. But building your primitives, just bringing it back, and what you need to do in order to have your infrastructure in place, you should never turn down a vendor call. There's always something that someone else is building that could be better, and don't be unafraid. Message to practitioners to listen, because you could be missing on a great tool or an opportunity.
Great, thank you, Ben. Let's get practical for a second. We talked before, Hillel, about how big banks and others are participating with stable coins, but I think one of the big debates has always been, what are they good for? What's the utility of them? And I think the one thing everyone seems to agree on is that the utility really comes down mostly to international and cross-border transactions, right? Everyone seems to agree that's where the utility of it is, or at least at best. So how would you see stablecoins practically perhaps disrupting things like Swift or even the card networks to some extent going forward?
Yeah, so the first use case has really been international, as you mentioned, cross-border payments, because of the FX component associated with it. There's area for disruption to disrupt the parties. There's so many parties involved in creating a cross-border transaction. And stablecoin really simplifies the process, and it reduces the volatility and cuts out some of the middlemen. So that's really the first use case. We've seen companies like Stripe and others power payments for global creators, for example, in USDC. And that's just the kind of thing that's quite simple and easy to do. The real question is, will stablecoin disrupt domestic payments and domestic activity? I have some, thoughts around this, which we haven't fully developed or crystallized, and it's definitely been written about by the various pundits. But is there this new stablecoin infrastructure that is being created for the fintech community? Can it be something that really you build upon instead of having to rely upon all the different payment rails in the US? That imagine that everything is really just transacted in stablecoin at the top layer, and underneath, who cares really how it gets moved, whether it be wire, ACH, RTP, push to card, etc. But in the end of the day, if everyone has access to stablecoin, it really simplifies the entire funds transfer or payment environment. And the real question is, what does happen to the card networks at that point? Do you need card networks to be able to do domestic transactions if you're moving on a stablecoin infrastructure? A lot of the things that card networks provide as far as security, stability, in those situations can be handled via a blockchain. Now, it's going to take a lot of adoption to get to that point. We're talking potentially years and multiple, even maybe tens of years away. But it's not like the networks are sitting back and letting the pitch go by and just trying to see what happens. They're getting involved too. There are a lot of discussions happening right now with card networks to pay acquirers from the acquiring perspective, potentially even on the card issuing perspective or side of the market. So it's a rapidly moving industry at this point, but it's going to take a significant amount of adoption to really disrupt those areas of the financial services market. We still have checks in this world, right? They're still not gone. A lot of people still get paid via checks, and there's still a lot of cash in the US. So we'll see what happens, but it's exciting. It's moving quickly, and we do think that it's from our perspective, we do need to support it.
Yeah, fantastic. And that's great. And I think maybe I want to get to other questions as well, other sections, and we can come back to this topic. And obviously, there's a ton, to Ben's point, we can spend a ton of time just on stablecoins themselves. But maybe again, keeping ourselves honest, Ben, back in January, you were optimistic that adoption of crypto and stablecoin would proliferate, and it's even for domestic use cases, not just international use cases, and gain credibility. Have you seen that actually play out? Maybe in a short thought, like has that come true, and or do you believe we're delayed on that?
Yeah, the answer is yes. I think you're seeing a lot of tremendous momentum. I mean, you think about the work that Cantor Fitzgerald's doing, with crypto native companies and bringing, digital asset activity to market through a wrapper, a securitized wrapper. We see companies exploring crypto-backed collateralized lending. It's proliferating everywhere. I think the IPOs that Noah mentioned earlier are just proof positive that this is here to stay. I do think the one thing I'm reflections, looking back, since we're talking about reflections, I think there are a lot of infrastructure providers, and that's that's interesting. I think that is where I would say we do have to sort of I think be very careful about what sort of infrastructure could actually be performed directly versus outsourcing, and there's a lot of them out there, and I think you'll see some consolidation. The answer is absolutely yes. We're seeing all over the place, and just closing the thought out, I mean, you're also seeing this cross-border topic. We should acknowledge that there were people, earlier entrants, that were all over this and really trying to work on the circles, ripples of the world, trying to move money cross-border. We should applaud their efforts to really get us to where we are today. So I'm bullish. I think it's not just stablecoin. Hillel will get upset with me, but it's not just stablecoins. I think it's the technology itself, which could be used for collateral. It could be used as a lending vehicle. I think there's a lot more ahead of us. But yes, we have seen the traction. I believe my prediction has come true.
Okay, great. So to end this topic, and I'll start with Noah. So let's be practical for a second and be a little predictive here. So I think we're starting to see those use cases. Ben, you mentioned collateral. I know there's a rebirth of lending against crypto. In fact, I think I saw that was it Fannie Mae? I think put something out that maybe they can leverage people's Bitcoin or for underwriting, or it's been out there in a few contexts. Maybe starting with Noah, where are you seeing the use cases practically for stablecoins and crypto coming into your business lines?
I think that the one that's front and center today is, as Ben noted, crypto and stablecoins serving as collateral for loans, whether it be a margin loan in a brokerage account, whether it be a secured credit card that's backed by crypto. In many senses, like the mechanistic ways that you can track in real time and liquidate, it does present like a really nice way for folks to borrow against it, especially on the stablecoin part of the world. The other thing that I think would be interesting that we haven't seen a ton yet would be really around the adoption with trustees in securitizations. For anyone who's ever closed an ABS deal, they've seen that 50-step sources and uses flow of funds where everyone's waiting for their Fed reference number, and it's a highly error-prone, highly manual process that could largely be streamlined by the use of stable coins and having really embedded smart contracts within that movement, that the process really could go end to end without having to have 10 people pushing buttons.
Yeah, I totally agree. And Hillel, putting your strategy hat on, where would you see the most utility or practical use case coming into play?
I mean, I think we mentioned it before, which was obviously cross-border payments, and then domestic on the acquiring side, I think are the first use cases that we are pretty excited about. I'd be remiss to say what we're actually focusing on and building at Cross River when it comes to stable coins. And where we sit in the ecosystem is, while we provide the infrastructure to move money however our companies want to see fit, all the real-time payment rails, all the various other payment rails as well, we sit between the interoperability between fiat and not. And that's where we think it's really exciting to provide a whole platform of services to our customers. And what we're building will allow our clients to work in the stablecoin world if they want to, and work in the fiat world as well. So being that infrastructure layer and supporting all of our clients, whether it be BaaS payments, lending, et cetera, we want to bring stablecoin functionality and services and continue to build on that. But to start with, really as a payment rail, and then we'll build out additional sort of stablecoin digital asset type services on top of that as well. So we really do feel like there's a lot of opportunity. We have a lot of companies talking to us about that today, and we're hearing their demand and building those solutions.
Yeah, great. Good plug there. And I think everything you're saying is certainly helpful to our business as well.
Yeah.
So maybe I want to get some time on the other buzzwords that are out there today, which is embedded finance and AI, of course. So there's I don't know how you rank order them, but I know they're all in the top three. You think that crypto/digital assets, stablecoins, and then AI and embedded finance. So maybe starting perhaps with Hillel, I'll read your prediction, Hillel, since I've already challenged Noah and Ben on theirs. So Hillel, back in January, you suggested a shift in embedded finance where banks might move up the stack and offer more services directly. How are we seeing that play out, and why?
So I think we're seeing it slowly. This is not one of those predictions that you could tell 100% in 6 months whether or not it's 100% true. I do think it's happening. I think we're seeing more embedded finance type companies come to the market. X, for example, announcing their financial services, which we all knew was going to come for a long time. More of those type of companies, I do believe strongly, will continue to come to market to offer financial services to their captured markets. And in order to serve those companies, banks will need to do more than they would have to do for traditional fintech companies. So I think it's inevitable. There are various examples out there of some companies like JP Morgan and PNC and others who are starting to offer other services for companies, more program management type services than I think you would have traditionally seen over the last few years. So more and more embedded finance companies looking to offer financial services, which in result means more banks offering additional services up the stack.
Yeah, totally agree. And obviously, I think that with platforms like X, what they do is they bring the AI and embedded finance together, right? They already have the AI, and now they're going to have financial services. I think it brings everything together. So that's great. Maybe going to challenge you, Hill, again, and also Noah on some predictions we made in January. So Hill, back to you for a second. So you also predicted that increased AI applications in KYC onboarding, fraud, and underwriting would proliferate. How have we seen these predictions play out? And B, has the regulatory framework evolved as expected?
So I'll let Ben talk more about the regulatory framework, but he actually said this before, but I don't think I can go a day or a few days without being pitched on another AI company focused on KYC compliance related activity. It is definitely the easiest use case from an AI perspective when you're looking at financial services of what to capture and what to attack. A lot of the manual services and manual options or operations associated with banks and compliance and back office was really being attacked by AI. There are tons of companies focusing on this right now. And to be honest, I don't think the barrier of entry is very high, right? You know, taking the AI models and applying them to things like onboarding, KYC, AML areas is extremely logical and easy. I wouldn't say easy to do, but relative to some of the other types of services in the market and areas to attack, it really is the low-hanging fruit. And we've continued to see tons of companies focusing on this. So I do believe that that's coming to fruition.
That's great. Ben, before we get to the regulatory piece of it, Noah, maybe why don't you give us a little snapshot of what you're seeing AI used for in capital markets?
Long term, the exciting piece is really around the orchestration layer, and I'll get to that in a moment. I think today it's really around like empowerment and efficiency, and I can give an example that we're using. You know, oftentimes when you're going through a diligence process, in terms of analyzing historical performance, credit and prepayment outcomes, we spent a lot of time previously trying to tease out why one vintage performed one way, why another vintage performed another way, when everything on the surface looks, you know, the exact same. I think via some of the AI tools that we are using and have built, we've really trained them to look and think a lot like, you know, a quant research analyst who can go through all the vintages and really parse out, hey, here are the attributes or here are the macro factors that are causing, you know, performance to act one way or the other. So one, it's efficiency, but it's also empowerment in that, like, you can have a front face capital markets person who's doesn't have the the quantitative background, and they can use these tools to really come to conclusions and help run folks through a diligence process. On the orchestration layer, I think we've seen some progress in terms of companies coming out there and helping with things like warehouse lending, borrowing-based monitoring, funding requests, et cetera. At the same time, those are very like on the surface style, efficiency enhancements. And if you think about it, like all the steps in, you know, borrowing money from a warehouse, you're preparing a borrowing base, initiating a funding request, testing for limits and triggers, you're processing the wirefalls, initiating wires. All these processes that are like very rules-based and iterative are classic things that could be like really one simple agentic flow. So I think that's sort of like what's on the horizon in terms of AI in capital markets.
It's great. And maybe Ben, to finish off the thought before I challenge you on a prediction you made, obviously the use of AI in some cases perhaps is less controversial, in others perhaps things like fair lending can be challenging. What are you seeing as far as the regulation or oversight of AI and the use of AI and how that's being handled by the regulatory agencies?
So I think, Adam, first I would say there's no substitution for a strong relationship with your regulator and your examiner, and that's something that Cross River takes seriously. So to that point, we engage regularly and talk about potential uses of AI. You have to make sure that you're understanding what your risks are. I think the challenges from regulators are that they see the potential. They do. And I want to be very fair. Like in conversations, they understand it, and they understand that you can use it to achieve efficiency. It's not only, as some would portray, replacing or supplementing out a human. I think it's actually adding rigor to your control framework in some ways and achieving efficiency. The concerns I think are around PIIs. I wouldn't even go just around fair lending. I would say and it touches on what Hillel said, Adam, earlier, is I think there's a lot of vendors and opportunities around transaction monitoring and AML and fair lending, right, with consumer data. And it all comes down to PII and how you protect your PII and to make sure that you're not, exposing your customers' data inappropriately or in a manner that poses risk. So I think that's where the concerns really are, and how you have the protections in place and in your governance framework. But there's open mind. I mean, if you talk to your examiner and examination staff and your regulator and you have an idea, they'll listen to you.
Okay. Yeah, great point. And that probably tees up the next question, which is with your prediction for January. I'll read it to you. It says, back in January, you recommended in-house compliance expertise, proprietary technology for oversight, transparent collaboration with regulators as some of the key compliance strategies for 2025. So has that held up? And then secondarily, have RegTech solutions come to the forefront and proven valuable?
Yeah, so going backwards, so RegTech solutions, have they proven valuable? I mean, we have made some progress. We have looked at some vendors, and we've integrated them into elements of our overall risk management framework. So yes, the answer is just a clear, resounding yes, without revealing names to them. What we've done though is it continues to go backwards, in that we did have dialogue with our examiners and our regulators. So yes, I think we've hit on that too. And where we've landed is really around just sort of crawling before we walk and finding areas that can improve efficiency, remove friction, and increase time. The time to our partners, to ourselves, and to the ultimate, the consumer, who in the end of the day is who needs to benefit more than anyone else. So I think we have. I forget what the first part of my prediction, or my crystal ball. You gave me the old,
I'm pretty sure you answered. You said about collaboration with regulators, proprietary technology for oversight, and then I talked about RegTech. So I think you're pretty sure you answered all of it in the prior two answers, but you want to add anything, go ahead.
No, I just think in closing, it's there. What's fascinating to me is that I think AI and blockchain technology are about to intersect, And that's what people seem to forget. We're looking at them in some sense we as an industry as two separate disciplines. I look at the proliferation of reg tech from my seat, someone who's always tried to put, the tech into the reg, as I think they're about to intersect, and they're about to intersect in different ways. So maybe it's a prediction for next year, but you're starting to see the use of blockchain technology along with the use of AI. I think together, and some of those products and those offerings are really going to be where we talk about next when we sit here next year.
I want to throw in one audience question, perhaps, to this section, and I'll throw this to Hill to start, and if people want to add, they can. One of the other buzzwords you hear now on AI is agentic AI. I know we've had a lot of automation. Most of the time when you call a bank or any other service, you tend to get an automated service, and it's to some extent self-help. And a lot of us, typically don't go to banks anymore anyway. We bank on our phones, and we bank in lobbies and machines, and so. I think agentic AI has been sort of the next generation of customer service. And maybe in your seat, Hillel, where do you see the most important uses for agentic AI, at least in our ecosystem?
I mean, obviously the customer service area, I think it was Klarna who announced that they took their entire back office and customer service area and is basically all automated via AI agents. From our perspective in the payments world, it's pretty interesting. We actually think that AI agents will actually start doing some functionality that was manual in the past. For example, like managing cash positions or contracts, treasury management, FX exposure, things like that. So you may see AI agents or agentic AI focus on those areas and automate a lot of the processes that are being handled typically from a back office operation and really automate everything that's going on there. So again, it's to be TBD because a lot of this stuff is highly regulated, highly sensitive, and you're definitely going to need some human activity to oversee a lot of this functionality. But it's definitely where we are headed. I think there was a post on LinkedIn yesterday which showed somewhere that someone with, obviously a browser from like ChatGPT or whoever, basically automating everything from a Robinhood like trading perspective, and basically just said, go buy $500, I think it was, of some basket of stocks, and the whole thing was done completely for them. And so I think we're headed in this world, we're headed in this direction, but there's a lot of dangers and areas where we have to be cautious and make sure it's being monitored and handled properly, or else it can really get, out of control.
Yeah, it was a daily email. I got it yesterday also
Yeah.
about the ability to trade. I think is the next phase of agentic AI. So yeah, so I think we're getting close to the end. I want to throw out two questions in conclusion before we get to any customer question, any panelist questions that have been submitted before. So maybe to start, maybe I'll start with you, Hillel, and then Noah, Ben, add in as well. CrossRiver provides a very wide array of solutions. We mentioned the products we cover, whether it be lending, whether it be cards, whether it be payments, whether it be deposit services, and we also go broader than that. We offer capital markets, investment banking, and compliance as a service. What could we add? What's the next thing CrossRiver could do to make our solution more robust? This is actually a submitted question from a participant.
What could be to be more robust? I mean, I think one of the areas that we are lacking is really from a client dashboard or information perspective, really accessing a lot of the customer data that we have. We need to bring it back to our customers in a way that's really helpful to them. And I do actually think that's where AI can come and be helpful with us in analyzing this data and providing additional services. But data is something that we know is extremely powerful and something that our customers can utilize if we present it to them in the right way. We've always focused really on that bottom infrastructure layer and AI APIs and service and basic, not basic, but like the real bare bones of the product and building solutions on top of that. Going up a little bit more and really accessing the information that we provide and the data of our customers and providing it in a way that can be utilized by our customers is something we're pretty excited about and we are building solutions for today.
Okay, and Noah, obviously, you're also sitting in a very important seat in advising clients on various things, whether it be securitizations, whether it be warehouse lines. What do you think we could add to our stable of products that would support our customers better?
I think it's an extension of what Hillel alluded to. We are at the nexus of a lot of where capital markets transactions are occurring. We're the ones manufacturing the loans. We're facilitating the execution of the capital markets. But if I think about the ability to monitor to go through diligence, to transact. That process still very much hasn't changed in the last 10, 15 plus years. So I think bringing more technology to facilitating transparency and more streamlined transaction consummation is something that we can and should be able to add.
Totally agree. And I mean, Ben, in your seat, you do a lot of the work behind the scenes to make sure that our programs are compliant and obviously meet regulatory expectations. What's something you think we can add? And maybe just to tee you up a little bit, I know you've been instrumental in helping build this CR Now network, allowing it to happen and move money between some of the crypto companies. And maybe in our support of fintechs, crypto companies, digital asset companies, stablecoins, what do you think we could do to add to our product set? And maybe talk about CR Now for a second as well.
Yeah, I think just at the top high level, and I'm conscious of the time, but we service a lot of earlier stage companies, and I think a good way to say it is with one of our core values is just compassion. Is that it's hard for a a small early stage company, someone who has a great idea, to comply with a lot of different obligations. They're partnering with a partner bank. I think if we could find a way to really develop a framework where we can give them a turnkey solution for compliance, a toolkit where it's almost like a roadmap. And I think either you or Hillel mentioned compliance as a service. I think that is an interesting development where we'd be able to allow innovators to come to market quicker and sooner. And I think it's also not, I think, in a company objective, but it's a personal mission of mine. I believe in that firmly. So that's how I would answer your first portion of your question. As for CR Now, I think what's interesting is about closed loop payment systems. There's tremendous value. Cross River, just allowing customers to move money where they're within the same walled garden infrastructure. They're all customers of Cross River, allowing them to move money between one another without having to leave the premises, as I like to say. And we still have the same proper controls in place that we would if they were sending an ACH or wire. I think is phenomenal. And what we're doing, what I would say about it is we're learning from the lessons of the past, from where other, we don't talk ill will about anyone, but I think where there was some challenges with prior iterations, we're addressing them. So we think our product is really scalable, and it's meant to be more than just crypto. It's allow any bank partner to move money between one another for one purpose or another, and it comes down to their expected activity. So I'm pretty excited about it, Adam. I'm pretty excited about it.
All right, feel the energy. Great. All right, guys, I get to ask the most challenging question. You got to be challenged on your first half predictions, and now I'm going to ask you to make a second half prediction, and we'll challenge you at the end of the year as well on this one. So maybe, Ben, sticking with you for a second, what is your single second half prediction for 2025?
Rules around cryptocurrency that let people keep talking about a bill, and someone who's a lawyer by background and who's lived a large portion of his career in crypto and market structure. I think everyone's got to take a deep breath, wait for the regulators to write the rules. The law says thou shalt not, and the rule says how one should go about and do it. So let's wait. Let's remain very optimistic and bullish, but let's also be cautiously optimistic at the same time.
So just to be clear, the prediction, because I'm going to challenge you on it later on, is regulation around cryptocurrency.
I think the President of the United States and the Crypto Task Force and the executive orders have made it clear that they want to see rules. And I think the bill that just passed, the Genius Act, sets certain dates, 180, et cetera, 120, to promulgate rules. So I remain optimistic we will see rules. So we will see rules, within that time frame. Whether we like them or not is another.
All right, Counselor. Mr. Cooper, what is your second half prediction for this year?
Maybe I'll respond from a markets perspective. I would say from a credit spreads and equity multiples perspective, I think they're likely biased, wider and compressed on the spreads and multiple perspective. I think valuations do look somewhat stretched to where we sit today. And then maybe just on the Fed and monetary policy, I do expect towards the latter half of the year that we actually do get a more aggressive rate cutting cycle than the Fed is currently saying via the median dot plots and the The very simple reason behind that is there's some interesting research out there saying the Fed has the two tools at its disposal, cutting rates and his balance sheet. The balance sheet has really been shrinking over the last several years, and that actually puts it in a much more restrictive place than we were even when rates were at 5.25. So I think the Fed comes to realize that and cuts rates 3 times this year.
All right, excellent. There you go. Hillel, leaving it with you to cap it off. To finalize the webinar, what's your prediction for the back half of 2025?
So I think coming full circle to what we talked about actually at the beginning of the webinar, which was Rule 1033, I think we're going to see consortiums of big banks come together to control the access and aggregation of data as sort of the solution to or workaround to what's going on with JP Morgan and accessing everyone's consumer data. I think the big banks come together as they've done many times in the past and try to control the market when it comes to customer data.
Wow. Okay. Very discreet. I like it. Okay. Excellent, guys. Thank you very much. This has really been fantastic, and look forward to seeing if our second half predictions come true in about 6 months. Thank you, everyone, for joining. Have a great day.